What if I told you the Federal Reserve may already be trapped, not politically trapped, not temporarily trapped, mathematically trapped? And the terrifying part? Most people still think inflation is going away. But behind the scenes, the US government is drowning in debt. Interest payments are exploding. Banks are quietly preparing for another liquidity crisis. And the Fed is stuck between two impossible choices: crash the economy or print even more money. And every single time they choose money printing, one asset keeps benefiting the most. Not gold, not stocks, not real estate, Bitcoin. Because Bitcoin was literally built for a world exactly like this one. Today, we're going to break down why inflation may be entering a second wave, why the Fed cannot fully stop it anymore, why billionaires and institutions are quietly repositioning, and why this entire economic crisis could become the biggest Bitcoin catalyst of the decade. But there's one detail almost nobody is paying attention to, and once you see it, you may never look at the dollar the same way again. Stay with me, because what I lay out there reframes the entire picture in a way that most investors have never considered. Before we go any further, nothing in this video is financial advice. This is education, research, and perspective. Always do your own due diligence. Consult a professional before making any investment decisions. Now let's get into it. Welcome back to the Wealth Continuum. If this is your first time here, this channel exists to do one thing only: help you understand the macro financial forces reshaping the world before the mainstream narrative catches up to them. Because by the time something is the headline story on every major network, by the time your neighbor is talking about it at the barbecue, the window of opportunity has usually already closed. The people who build real wealth don't react to news. They anticipate the conditions that create it. And right now, there is a very specific set of conditions developing in the global economy that most investors either haven't noticed yet or haven't connected into a coherent picture. Quick question before we dive in: morning, afternoon, or night? Where you are right now, drop it in the comments. This community watches from every corner of the world, and I genuinely love seeing that. Now, let me take you back to a decision that set all of this in motion. For the better part of 3 decades, the Federal Reserve operated on a single core belief: when the economy stumbles, print money. When markets panic, inject liquidity. When banks start teetering, open the emergency lending window. Recessions, corrections, credit crises. The answer was almost always the same: create new money, buy time, deal with the consequences later. 2008, the Fed cut rates to near zero and launched its first major quantitative easing program. They bought trillions in mortgage-backed securities and government bonds to stabilize a collapsing financial system. It worked. Crisis averted. But the balance sheet expanded dramatically. 2020, a global pandemic shuts down economies overnight. Congress passes trillions in fiscal stimulus. The Fed simultaneously expands its balance sheet at a speed and scale never seen in American history. By mid-2022, the Federal Reserve's balance sheet had swelled to nearly $9 trillion. $9 trillion of artificial liquidity pumped into the veins of the financial system. Markets recovered beautifully. Asset prices hit record highs. Unemployment fell to generational lows. But there was a cost, and that cost had a name: inflation. By the middle of 2022, the United States Consumer Price Index had reached over 9% year over year, prices not seen since the early 1980s. Groceries, gasoline, rent, car insurance, home prices, airfares, medical expenses, utility bills. Everything went up simultaneously, and ordinary working people felt every single dollar of it. The Fed was forced to act. They launched the fastest and most aggressive rate hiking cycle in roughly 40 years. Starting from near zero in early 2022, they raised the federal funds rate to a range of 5.25% to 5.5%, a pace and magnitude that stunned even veteran market observers. The stated goal was simple: cool demand, kill inflation, restore price stability. But here is the part that almost nobody at the dinner table is talking about. When you raise interest rates at that speed and to that level, you don't just cool the economy, you also make every single dollar of existing government debt dramatically more expensive to carry. The United States government is carrying a lot of debt. As of early 2026, the national debt has crossed well past $36 trillion and continues to climb with every passing week. Think about what that means in real terms. Every single percentage point increase in average borrowing costs across the government's debt portfolio adds hundreds of billions of dollars to the annual interest bill. That money has to come from somewhere. It either comes from cutting spending, which is politically almost impossible in any modern democratic system. It comes from raising taxes, which faces its own enormous political resistance. Or it comes from issuing more debt to pay for the existing debt, which simply compounds the problem further. Or eventually, it comes from the Federal Reserve stepping back in and monetizing that debt, which is money printing. with extra steps and longer words. There's no version of this story that ends cleanly. This is exactly why some of the most respected macroeconomists and institutional investors in the world are quietly but persistently making a single argument. The Fed is trapped, and markets are only now beginning to price in what that actually means. Do you think the system can hold itself together? I want your honest answer in the comments below. No judgment, just real thinking. Here's the story most people have absorbed and accepted. Inflation happened because of a perfect storm. COVID disrupted global supply chains. Governments flooded economies with emergency stimulus money. Demand exploded while supply was constrained. Prices spiked. The Fed raised rates. Inflation cooled. Story over. That narrative is dangerously incomplete, because inflation is not a temporary weather event. It is not a viral outbreak that runs its course and disappears. Inflation, when it becomes embedded in wages, housing costs, energy systems, and supply chain structures, becomes structural. And right now, in the spring of 2026, there are at minimum 6 distinct forces that are keeping inflationary pressure alive in ways that interest rate policy alone simply cannot fully address. Let me walk through each one. The first is government spending. Federal deficits in the United States remain at levels that were once considered extraordinary but are now treated as normal operating conditions. Trillion-dollar annual deficits. Every dollar the government borrows beyond its tax revenue is, at its core, new purchasing power being injected into the economy. That is structurally inflationary. The second force is geopolitical fragmentation. The era of frictionless globalization, where any product could be manufactured at the lowest possible cost anywhere on Earth and shipped anywhere else with minimal tariffs, is ending. Supply chains are being reshored. Strategic industries are being ring-fenced. Tariffs and trade barriers are rising between major economic blocs. All of this raises the cost of producing and distributing goods. All of this embeds higher prices into the baseline. The third force is the energy transition. Shifting the global economy away from established fossil fuel infrastructure toward renewable systems requires trillions of dollars in new investment. Power grids need to be rebuilt. Charging infrastructure needs to be deployed. Storage technology needs to be scaled. Industrial processes need to be redesigned. That capital expenditure flows through the economy as cost. It shows up in electricity bills, in construction materials, and commodity prices. The fourth force is the artificial intelligence infrastructure build-out. This is a newer and frequently overlooked inflationary pressure. The AI arms race among technology companies, governments, and financial institutions requires massive quantities of energy, physical computing hardware, specialized chips, and purpose-built data center facilities. That build-out is accelerating, not slowing. And the energy and materials demand it creates is real and immediate. The fifth force is demographics. In the United States, Europe, Japan, and China, the 4 largest economic blocs on Earth, populations are aging. Workforces are shrinking relative to the retiree base. Labor markets remain tighter than historical norms would predict. When workers become scarce, wages rise. When wages rise, the costs of every service that relies on human labor rise with them. That is a multi-decade structural force. The sixth force is the psychology of inflation expectations. Once businesses believe prices will keep rising, they raise prices preemptively. Once workers believe inflation is persistent, they negotiate for larger wage increases. Once consumers expect higher future prices, they spend today rather than save. All of these behaviors reinforce inflation rather than correct it. Now consider this carefully. The Federal Reserve can raise interest rates, but raising interest rates does not rebuild a supply chain. It does not lower the cost of energy transition infrastructure. It does not reverse demographic trends. It does not stop a government from running trillion-dollar deficits. All interest rate increases do is raise the cost of borrowing, slow demand, and create economic pain across households and businesses. The underlying structural inflationary forces remain. Hit like if this is starting to click. Because what comes next is the part that genuinely unsettles serious investors. Now here's the part almost nobody is connecting right now. There is a very specific mechanism building quietly inside the global financial system. A mechanism that has triggered before. And every single time it has triggered historically, Bitcoin has done something remarkable. I'm going to show you exactly what that mechanism is and why the setup today is more powerful than it has ever been. But first, you need to understand the debt spiral. The United States is not simply in debt. It is in a compounding debt spiral. And the distinction matters enormously. A debt spiral is not just having a large debt balance. A debt spiral is a self-reinforcing loop where the cost of the debt grows faster than the economy's ability to generate revenue to pay it. Here is how it works in practice. The government spends more than it collects in taxes. To cover the gap, it issues treasury bonds, borrowing money from investors, foreign governments, pension funds, and the Federal Reserve itself. That borrowing carries an interest rate. As rates have risen sharply over the past several years, the interest rate on new and refinanced borrowing has risen with them. So when older low-rate government debt matures and has to be rolled over, it gets refinanced at today's higher rates, which means the interest bill automatically grows each year, even if the government borrows nothing additional. Even if deficits magically disappeared tomorrow, the interest on existing debt keeps compounding. And here is the number that should stop you cold. In fiscal year 2024, the United States paid approximately $1 trillion in net interest on its national debt. $1 trillion. To put that in context, that figure surpassed the entire defense budget. It surpassed the entire Medicare budget. It was the single largest non-discretionary line item in the federal budget, and it was spent on absolutely nothing productive. No roads, no schools, no military capability, no health care, no research, no infrastructure, pure interest on debt that already existed. And the Congressional Budget Office projects that this interest burden will continue growing as a share of the budget for years to come. Some independent analysts now project that interest costs could consume close to a fifth of all federal tax revenue within the next several years. Think about what that does to the political and economic math. The government faces increasing pressure to spend more on defense, on social programs, on disaster response, on economic stimulus when the next recession hits. But an ever-growing share of its revenue is pre-committed to paying interest on past borrowing. The only three options are cut other spending dramatically, politically nearly impossible, raise taxes significantly, also faces enormous political resistance, or borrow more and eventually pressure the Fed to ease monetary conditions. Option 3 is historically what has actually happened, every time. And here is the critical insight. The pressure for the Fed to eventually pivot back toward easier monetary conditions is not coming from outside the system. It is being generated by the system's own internal mechanics. The debt spiral makes monetary easing almost mathematically inevitable at some point. Not this quarter, perhaps. Maybe not this year. But the direction of travel is not random. Are you positioned for that moment? Or are you still on the sidelines trying to time a perfect entry? Because the people asking that question now are the ones who will be early when it matters. Bitcoin was not invented by a tech company looking for a new revenue stream. It was not created by a government trying to modernize its currency. It was not designed by a bank hoping to streamline settlement. It was created by an anonymous individual or group operating under the name Satoshi Nakamoto in 2009. And it was created in direct, explicit response to the 2008 financial crisis. The very first block ever mined on the Bitcoin blockchain, what is called the Genesis block, contained an embedded message, a newspaper headline from January 3rd, 2009. The headline read, "Chancellor on brink of second bailout for banks." That was not an accident. That was a mission statement. Bitcoin was designed as a direct answer to a single question. What would money look like if no government or central bank could ever manipulate its supply? And the architecture of Bitcoin reflects that question precisely. There will only ever be 21 million Bitcoin in existence, not 22 million, if economic conditions require it. Not 25 million if a crisis demands stimulus, not 30 million if a government decides it needs more. 21 million, hard-coded into the protocol, mathematically enforced by thousands of independent computers around the world running simultaneously. No committee can change it, no election can override it, no executive order can modify it, no emergency legislation can expand it. The supply is fixed, permanently. In a world where the supply of fiat currency is determined by the political pressures facing a small committee of central bankers, that fixed supply is a radical and powerful property. On top of that, Bitcoin is decentralized in a way that no other asset in history has achieved at scale. No single entity controls the network. No government can shut it down unilaterally. No corporation can freeze your holdings. No bank can deny you access to your own balance. And unlike gold, which shares some of these properties, Bitcoin is digitally transferable anywhere on Earth within minutes. Divisible to 8 decimal places, programmable, publicly auditable, every transaction, every coin in existence, every wallet balance, verifiable by anyone with an internet connection. Now let's look at where we are in May of 2026. The most recent Bitcoin halving occurred in April of 2024. That event reduced the rate at which new Bitcoin is created, as a reward to the miners who maintain the network, by exactly 50%. Before that halving, approximately 900 new Bitcoin were being created and entering the market every single day. After the halving, that figure dropped to approximately 450 per day. And the next halving, expected around 2028, will cut the figure in half again. Meanwhile, demand has been growing. The approval of spot Bitcoin exchange traded funds by the Securities and Exchange Commission in January of 2024 opened the institutional floodgates in a way that nothing before it had. Within months, BlackRock's iShares Bitcoin ETF became one of the fastest accumulating ETF launches in financial history. Pension funds, insurance companies, registered investment advisors, endowments, sovereign wealth funds, all suddenly able to access Bitcoin exposure through a regulated familiar vehicle. That institutional demand does not evaporate with a bad week. It does not panic sell on a negative headline. It rebalances on quarterly schedules and accumulates on dips. It creates a structural demand floor that simply did not exist in any previous Bitcoin cycle. Subscribe if you want to stay ahead of what's coming. Because the next section covers a mechanism most retail investors have never even heard of, and it may be the most important part of this entire breakdown. Here's the piece that most retail investors completely miss. And I genuinely mean completely. When people think about money printing and central bank liquidity, they picture the obvious moments. The Fed announces a new quantitative easing program. A press conference happens. Jerome Powell, or whoever holds the chair, stands at a podium and the headlines write themselves. But there's a parallel liquidity world that operates far beneath the headlines, continuously, quietly, at enormous scale. Repo facilities, reverse repo operations, Treasury General Account drawdowns, the Bank Term Funding Program, emergency bank lending windows, central bank currency swap lines between the Fed, the European Central Bank, the Bank of Japan, and the Bank of England, sovereign wealth fund reallocation cycles. These mechanisms inject and withdraw liquidity from global financial markets on a constant basis. And Bitcoin, more than almost any other asset class, has shown a remarkable and growing correlation to changes in global liquidity conditions. Let me give you a concrete example. Think back to the regional banking crisis in early 2023. Silicon Valley Bank collapsed almost overnight. Signature Bank followed. The Federal Reserve was simultaneously claiming to be in aggressive quantitative tightening mode, reducing its balance sheet, draining liquidity, fighting inflation. But within days of the bank failures, the Fed launched the Bank Term Funding Program, a new emergency lending facility that made hundreds of billions of dollars of liquidity available to stabilize the banking system. The Fed was officially tightening with one hand, while quietly injecting massive emergency liquidity with the other. And Bitcoin, within weeks of that program being announced, began one of its strongest sustained rallies in years. Coincidence? Perhaps. But it is a pattern that has now repeated across multiple cycles. Multiple macro analysts and institutional research desks now track an aggregate measure called Global M2. This is a combined measure of money supply across the major global economies: the United States, the European Union, China, Japan, and the United Kingdom primarily. When Global M2 expands, risk assets broadly, and Bitcoin specifically, tend to follow. When Global M2 contracts, markets pull back. The correlation is not perfect. No correlation in markets ever is. But it is consistent enough that serious macro investors now integrate global liquidity tracking directly into their Bitcoin thesis. And here's the setup that matters right now. As of early 2026, multiple major central banks, including the People's Bank of China and the European Central Bank, have already moved into active easing cycles. China has been cutting reserve requirements and injecting stimulus into its slowing economy. Europe has been reducing rates as growth stagnated. The global liquidity tide has already begun turning. The United States has not fully joined that cycle yet. But with debt service costs exploding, with economic growth showing signs of softening, with housing markets under pressure, with corporate credit conditions tightening, the probability of the Fed eventually joining the global easing cycle grows with every passing quarter. And the question that serious Bitcoin investors are asking is not whether that happens. The question is, how much of the move will have already occurred before the mainstream acknowledges it? This is where smart money is already moving. If you've made it this far, you're already thinking about this more clearly than the vast majority of people engaging with financial content today. But there is one final piece to this picture, and it may be the most important piece of all, because it is the piece that explains why this cycle is fundamentally different from every Bitcoin cycle that came before it. Every previous Bitcoin market cycle shared a common characteristic. Retail speculation was the dominant force. Individual investors, early adopters, online communities, developers and idealists, people who believed deeply in the Bitcoin thesis, but who also had the emotional and financial vulnerability to panic and sell when markets turned against them. That dynamic produced the famous Bitcoin volatility pattern, a massive parabolic rally driven by speculative enthusiasm, followed by an equally brutal crash as retail sentiment flipped and weak hands sold. Often a 70, 80, even 90% drawdown from cycle peaks, followed eventually by a recovery in the beginning of the next cycle. Repeat. That playbook was consistent and largely predictable for over a decade. But something structurally significant has changed, and it changes the entire risk-reward calculation for Bitcoin going forward. Three transformative developments have materialized between 2024 and where we are today. The first is institutional infrastructure. The spot ETF approvals in January 2024 did not just open a new way to access Bitcoin. They fundamentally changed who holds Bitcoin and how they hold it. Institutional investors, pension funds, endowments, wealth management platforms, insurance companies operate on entirely different timeframes and with entirely different behavioral dynamics than retail investors. They do not check prices every hour. They do not make decisions based on social media sentiment. They rebalance on quarterly or annual schedules. They have mandate-driven holding requirements. They accumulate on weakness rather than panic selling into it. This institutional layer creates structural support levels in the Bitcoin market that have never existed before. The second development is corporate treasury adoption. Companies like MicroStrategy have now accumulated hundreds of thousands of Bitcoin on corporate balance sheets, effectively becoming publicly traded Bitcoin holding vehicles. Other corporations have followed, adding Bitcoin to treasury reserves as a hedge against dollar debasement. This represents a new category of permanent long-term demand that does not liquidate on market volatility. The third development, and this is the one that has most fundamentally shifted Bitcoin's narrative, is the discussion of sovereign Bitcoin reserves. El Salvador's adoption of Bitcoin as legal tender in 2021 was widely dismissed as a fringe experiment. But by late 2024 and into 2025, the conversation had moved to an entirely different level. Discussions emerged in the United States around the concept of a strategic Bitcoin reserve, a formal government holding of Bitcoin as a reserve asset alongside gold. Whether that fully materializes in any specific form, whether it is adopted as official policy or remains a political proposal, is almost secondary. The fact that it is being debated seriously at the level of national economic policy represents a legitimacy threshold that Bitcoin has now permanently crossed. And here is the supply dynamic that makes all of this matter so acutely. If even a handful of nation-states begin treating Bitcoin as a reserve asset, the supply of Bitcoin does not increase. 21 million coins is the ceiling. It will always be the ceiling. But the demand pool just expanded to potentially include sovereign balance sheets alongside institutional portfolios, alongside retail investors, alongside corporate treasuries. Comment below. Do you think sovereign Bitcoin reserves become a reality for major economies within the next 5 years? Seriously. I want to know what this community thinks about where that conversation goes from here. Let me paint you a scenario, not a prediction, a scenario, one that a growing number of macro investors are quietly preparing for behind the scenes. Imagine the global economy slows sharply over the next couple of years. Corporate earnings weaken. Housing starts cracking under high mortgage rates. Regional banks begin struggling again because of commercial real estate exposure. At the exact same time, the US government faces an exploding interest burden from its massive debt. And eventually, the Federal Reserve does what markets always expect it to do during stress. They pivot. Rate cuts begin. Liquidity returns. Maybe it's not officially called quantitative easing, but money starts flowing back into the system again. There's just one problem. Inflation never fully disappeared. Government deficits are still massive. Energy costs remain unstable. Global supply chains are fragmented. Labor shortages continue. So now you have something extremely dangerous. A weak economy combined with stubborn inflation. That combination has a name, stagflation. And historically, stagflation is one of the hardest environments for traditional assets to survive. Bonds lose value because inflation eats away at returns. Stocks struggle as profits weaken and costs rise. Cash quietly loses purchasing power every single year. Real estate faces pressure from affordability and expensive financing. Even gold, the traditional inflation hedge, has limitations in a digital world. Bitcoin doesn't. It's globally transferable, mathematically scarce, verifiable instantly, accessible 24 hours a day, and if self-custodied correctly, it exists outside the traditional banking system entirely. That's why more investors are starting to look at Bitcoin differently, not just as a speculative trade, but as insurance against a financial system that may be reaching its limits. And whether this exact scenario happens or not, the fact that serious investors are even discussing it tells you how much confidence in the current system has already started to crack. Now here's the part most people underestimate. This story is ultimately about trust. Think about what ordinary people have experienced over the last 15 years. The 2008 financial crisis, massive bank bailouts, money printing after COVID, 40-year high inflation, regional bank failures, a cost of living that keeps rising faster than wages. Meanwhile, housing feels increasingly unreachable for younger generations. Savings accounts lose purchasing power. And every crisis seems to end with more liquidity injections and more debt. For many people, the old financial system no longer feels stable. It feels fragile. And into that environment comes Bitcoin, an asset with a fixed supply, an asset no central bank can print more of, an asset that can be held without relying entirely on traditional financial institutions. That narrative becomes more powerful every time inflation spikes, every time banks need emergency support, and every time people feel like the rules of the system keep changing. The Bitcoin story isn't growing because of marketing alone. It's growing because trust in traditional systems is slowly eroding. So the real question isn't whether inflation ticks slightly higher or lower next month. The real question is this: what happens to your financial future if the purchasing power of money keeps quietly declining for the next 10 years? What happens if scarce assets continue absorbing global liquidity while cash steadily loses value? Those are not just Bitcoin questions. Those are money questions. And Bitcoin is becoming one of the most serious answers to those questions anywhere in the world right now. If this video made you think differently, subscribe and turn on notifications, because we're going much deeper into these macro shifts in upcoming videos. And comment below, do you believe Bitcoin is becoming a genuine escape hatch from a broken monetary system? Or do you think the current system is far more resilient than people believe? I read every comment. Stay sharp, stay early.